Hey guys, welcome back to the channel. In today's video, we'll be talking about stock market. I'll be giving you some pointers on how to invest into stock market. I'll not necessarily talk about individual stocks, but I will talk about my portfolio. I will talk about what I invest in and what are the fundamentals that I invest with. So if you're new to the stock market or in general curious about how I invest my money into the stock market, this video is for you. So let's get started. So in today's video, we'll be talking about why I invest. That's very, very important. Understanding the why is important, and we'll talk about that. I'll also talk about where do I invest. I'll also talk about how do I invest. So there are three reasons why I actually invest in stock market. The number one reason is because the bank and the government left me no choice. Let me explain this. Now let's talk about the government first. They control the money flow. In COVID, they printed $400 billion, and that was just in Canada. There was a lot more money that was printed, down south in the US. Now, the problem with that is when there's more money being printed, there will be inflation because now there is more supply in the market, money supply in the market, and there is not limited supply of goods, and there are more people with money who are buying those same goods. We saw that in the stock market. We saw that in asset classes like real estate, crypto. Everything went up when there was more money in the economy. And now that there is too much money in the economy and we have high inflation, interest rates are being cut, taxes are very likely to go up, and all this is actually controlled by the government, and I personally do not like that. And linked to this particular control that the government has is also interest rates. Now, when I put my money into the bank is actually giving me a higher interest rate, but that's the catch. It's not just higher interest rate, it's higher because inflation is also high. When inflation was 2%, the bank was giving me not even 0.05, 0.01, whatever that percentage was. It was very minimal. And now the inflation is 7.4%. And now the return that the bank wants to give, and this is actually EQ Bank where I keep my emergency fund, that is actually 1.65%. Other top banks are actually lower than this. So what this means is that if I save $100 today, the bank is going to give me $1.65 at the end of the year in interest. So my $100 becomes $101.65. However, the $100 grocery that I was buying today will cost me $107 next year, and the $1.65 that the government is giving is not enough. We discussed that in our previous video when we talked about recession as well. And what happens is if you save $500 a month for the next 30 years, assuming a 2.5% inflation, 2.47 inflation, which is over the last 30 years, our $180,000, which is $500 per month, for 12 months into 30 years will actually be worth $125,000, which is 30% less. However, if I invest the same money in the stock market at 7% year-on-year return, I'll end up with $600,000. And yes, this money will be worth 30% less because of inflation, but it'll be a whole lot more than the $125,000 worth that I'll have if I save the money in the bank. And that's why I say that the bank and the government has actually left me no choice, because the government controls a lot of things that actually causes inflation and my money to depreciate, and therefore I have to beat inflation every single time, and the bank then dangles a higher interest rate return for my savings. However, that interest rate is actually not beating inflation, so I have to invest. I just don't have any other choice. Now let's talk about the second reason why I invest in the stock market, and the reason is the bank is actually making money off my savings. This is something that I did not realize until a few years ago, and that's something that's really important to understand. Let's understand how the bank makes money. This is me who now puts $100,000 into the bank account thinking that it'll give me a return of 1.65%, which is $1,650 on the $100,000 that I saved in the bank account. I have the safety in that money, but again, that's actually depreciating at about 6 to 7% today. Now, what the bank does is it gives $50,000 to another person who apparently looks like me as per the graphic, but they actually are buying a car, and the bank lends the $50,000 of the $100,000 to this person who is buying the car. And now in today's world that we are living in, this guy is actually paying 6% interest on the auto loan that they have taken, and that actually accounts for $3,000. So the $1,650 that I am getting on my savings, part of that, 50% of that is being used to lend at 6% to another person to buy a car. And that's $3,000. That's almost double of what I am getting that the bank already made with half the money that I saved in the bank. And then the other $50,000 goes to a house that this person is buying at 4%. That's $2,000 a year that this person is paying in interest to the bank. So the bank actually makes $5,000 from the $100,000 that I invested. Actually, it was saved in the bank account. However, they only give $1,650. Now, this is an oversimplistic way of understanding how money works, how bank works. Obviously, there is a lot more things that the bank does with the $100,000, but this is basically the model on which banks work. And now, this is still not the worst kind of debt. You have credit card debt, people defaulting, people paying 19, 20, 25% interest rates on personal loans and credit card loans. And this actually gets worse. Car loan and home loans are actually not the ones that are dooming the society. It's basically the credit card debt, and all that is actually coming, all that lending is actually coming from our savings that we are doing in the bank account. I don't know about you, but if I save my money, I make the bank rich and myself poor, and I don't want to do that, and therefore I invest in the stock market. And the third reason why I want to invest in the stock market is that because I want to become financially free. I want to retire with enough money that could fund my retirement, and I do not have to work for 65, 70, 75, 80 years in order to make a living. And that's very, very important. And I talked about this in our previous video, but let me just recap. If you invest your money $500 every single month, and if it grows 7% year on year, which is a very nominal return, and we'll see that in the next slides, in 30 years, it will be worth $600,000 plus. If I invest $1,000 in 30 years, it will be worth 1.2 million, and so on and so forth. And why the 4% retirement rule, which basically means that if I have the money $600,000 in the bank account, and if I draw 4% of that money every single year, and remember this money is actually growing at 7% year on year on average long term, I'm actually not exhausting the $600,000. That also keeps on growing, but I just take out 4% of that every single year to fund my retirement forever. And that money will be $24,000 a year if I invest $500 per year for the next 30 years. And again, if I invest $2,000, $5,000, that money will be a lot more. And in the last video, I talked about how in order to fund my retirement well, I'll have to be in between that $2,000 per month or $5,000 per month, depending on what else I'm investing in. But I have to be in that quadrant in order to fund my retirement comfortably. And just saving the money in the bank account and not investing into the stock market or other vehicles will not get me anywhere. Now that we understand the why, let's talk about the where. And a lot of people actually complicate stuff here. You know, there is so much information out there that we should do this kind of analysis, we should do a long-term cash flow analysis, and we should invest in these kind of stocks, and we should invest in these kind of industries. I just want to make it very, very simple. And the most simplistic way of investing is to invest in the economy that you believe in. Whether it's the Canadian economy, whether it's the US economy, whether it's the Indian economy, you invest in the economy. Now you might ask, Navjot, how can I invest in the economy? Let me explain. So I have a budget of $2,000 every single month that goes, this is a real budget, $2,000 every single month that goes towards investing in the economy. And the way to do that is I split that $1,000 into two parts. Number one goes into the top companies in Canada. Economy is made by companies, economy is made by industries. VDY is one ETF that actually invests in the top 500 companies in Canada. We have XIC, XCI, VRE. It has different portfolios. Someone is banking heavy, someone is energy heavy, someone is a little bit tech heavy, someone is dividend heavy. All this actually makes for a lot of the top companies in Canada, and therefore I'm investing $1,000 into the Canadian economy. Same way, the other $1,000 goes into S&P 500. There's an ETF called VFV, VOO. It's not important which one you invest in. Yes, there are differences in the way dividends are taxed and everything, but it's important to invest. And in all, over the last 20, 30 years, we get a return if we reinvest dividends of 7 to 8% in the Canadian economy, which is these 4 or 5 ETFs that I have listed down. I actually invest equally into these 4 ETFs. And then if I invest the $1,000 in S&P 500 for the next 30 years, looking at history, I'll be making anywhere between 9 to 10% return. If I reinvest the dividends, it could be a little bit higher and lower depending on how the economy, pans out. But if I believe in the Canadian economy and the US economy, which I do, I would just get a return anywhere between 7 to 10%, which is enough for me to fund my retirement. And that's why I said that we need to keep it very, very simple. The number 2 strategy is also very simple, and it's in investing in individual stocks. But it's not just any stocks. It's not because a friend told me that this stock is going to do well. I invest in 2 very simple things. Number 1 is that I invest in stocks that I believe in and I use. I invest in Walmart. I go to Walmart every single week. I spend $300, $400, $500 every single month in Walmart. I would want to invest and I would want to take a share of those profits. I actually worked with Walmart, so I know that there's longevity in the company. They are going online, they are very progressive. So I like Walmart and I would want to invest into Walmart. I would want to invest in Costco because it has a very different place in the Canadian economy and in fact the US economy. It's a wholesale store. I don't think it's going anywhere. And then I also want to hedge my retail investments with investing in Amazon, which is very much online, which is very different from how Costco and Walmart are positioned. And then there's Dollarama, which has a very different position in Canada, and it has actually given me a lot of returns in the last 2 or 3 years. Then there's Google. I'm a YouTuber. I'm making these videos on YouTube. YouTube is the second biggest research engine after Google itself. So it's basically Alphabet that I invest in. But yeah, Google has actually tested the time. And I really believe in this tech stock. And that's why I invest into it. And I want to invest in Tesla. I would want to own a Tesla someday because it's very, environment friendly. And I really believe in the technology. And I really believe that this company can do wonders. And that's probably the most risky stock that I own in my portfolio. And I'm not saying these are the only stocks that I own. I just say that I actually believe in these companies, and your companies could be very different, but it's very important to keep it very simple and to invest in companies that you actually believe in and that they have tested the times. It's very important to invest in companies who are not one-trick pony. I'll give an example. For example, Shopify. Now, Shopify, I have invested a little bit of money, but I do not believe that Shopify has the longevity. And I have nothing against Shopify. I love Shopify. They are doing very well. They are a good tech company. They are a unicorn status. But what if there's another Shopify company, equivalent company that comes up in the future who just kills Shopify completely? And I'm a long-term investor. If I'm investing in a company, I would want to invest for 30 years continuously, one bit at a time, but I would not want the company to actually die down and become zero. Same way Facebook, right? Facebook is amazing. They have Instagram. I love Instagram. Facebook is kind of dead right now, or it's actually declining, or it's just appealing to a different audience. But the thing is that what if there's another social platform that comes up, which is better than WhatsApp, Instagram, whatever, right? I do not want to invest in those companies that are one-trick pony and that are not long-term. Now, that's just my strategy. Your strategy can be different. And that's what I'm saying, right? We need to keep it simple and we need to keep investing in some things that we actually believe in. And the second one is that I invest in other people's stupidity. And I'm not being rude here, but that's true. A lot of people actually invest their money into liabilities. And they do that using credit cards, and therefore I invest in Visa. Visa has given 10.9% returns over the last 20 years, and they'll continue to do that because there will be people who will be defaulting on their credit card loans. There will be people who will be buying shit that they can't afford, and there will be people, those same people, who will be paying 19%, 20%, 25% interest on their balances. And I want to take a share of that stupidity. I'm not being rude to people who do that. I'm just being an investor here. And therefore, I also invest in banks because banks actually work with all these credit card companies, and they also get a lot of share of all this debt that a lot of people take, the bad debt that they take. Plus, there's a lot of good debt that's there in the banks as well. I have a mortgage. I would love to own shares of my mortgage company because if I'm paying a mortgage and if I'm paying interest, I would want to take a little bit part of, what I'm using. So I actually invest in all these things. These are just principles. It doesn't have to be your companies. I'm not giving any financial advice. Make sure you do your own research and invest in things that are not very complicated and invest in things that are long term. And that's just my suggestion, and you don't necessarily have to follow that. Now, lastly, let's talk about the how. And there are 3 things that I want to talk about here. One is the frequency. When do you invest? How often do you invest? How often do I invest? Then we talk about vehicle, and I'll talk about that in a bit. And then I also talk about the platform. That's also very important. Whether it's a bank or an app, we'll talk about that. Now, there are 2 types of strategies that long-term investors do. One is a monthly strategy, a weekly strategy. You can't go wrong there. But the point here is that whether the market is up or down, the ETF is up or down, the stock is up or down, you invest every single month on the 1st of every month. I used to do that 3 or 4 months ago, but now I actually do every Wednesday, which is a weekly investment of $500 per week. That's about $2,000 a month. I was doing $2,000 a month on 1st of every month, but now I'm doing it weekly just to get that dollar cost average and just to have an automated way of investing throughout this recession. I just don't want to miss out on any ups and downs which are happening every week now. You can't go wrong in either. Then there are traders who are actually trading stocks every single day. There's nothing wrong with that. That's just not my style, and I require a lot of, I just don't have the time to spend on trading stocks and having multiple screens. I have a full-time job as well, but there are people who are doing this very, very well. It's just not my cup of tea. And then there are investors who do it out of FOMO because the friend has invested in so and so stock and therefore I have to do it, and they do it 1 month and then they do it in the 6th month and then they do it after 2 years. That's FOMO investing, and that's the one that we need to stay away from. We either invest or we don't invest. It should not be based off of someone else's research. It should be based on our own research, and we need to be long-term investors. So whatever money that I'm investing right now, if it's $2,000, I actually invest that money every single month, and I'll continue to do that for 30 years without looking at whether the stocks are going down or not, because I want to use this money to fund my retirement. So my investment strategy is I do it weekly. And now let's talk about the vehicles that you use to invest money. Now the most popular ones are TFSA, RRSP and RESP. Now there are limits to each one of those. TFSA is tax-free savings account. I love this because you actually, whatever money you get after deduction of tax from your salaries, you can actually invest $500 a month, $6,000 a year. The maximum is $6,000 a year. You can do it in one go, or like we do it, $500 a month. I actually invest, both me and Simran invest $500 a month into TFSA. So that's our strategy, $500 for me, $500 for Simran, and we just invest $1,000. And we usually do our Canadian investments of $1,000, which are the Canadian ETFs that we have, 4 ETFs. We actually do that through our TFSA account. Now, if you have kids, RESP is an amazing one to fund kids' educations, and RRSP is a good investment vehicle if your company is also matching your contribution. But we personally, because we are business owners, we personally do TFSA only, and that's $1,000. And the second kind of vehicle is non-registered, which is your basically personal account. It's not linked to any tax shelter or anything. It's just personal investment that you do into stocks or ETFs. You can do the same thing that you do in TFSA in your personal account as well. It's all on the same platform. We'll talk about that in a bit, but we invest $1,000 into, that we talked about in the last section, $1,000 of US investments on the ETFs actually go through the personal account. And then we also do about $1,000 of investment in the individual stocks that I talked about every single month. So that's $2,000 in ETFs, $1,000 in Canadian ETFs, then I have $1,000 in US ETFs, and then I have about $1,000 going into individual stocks, and that's $3,000 that we invest every single month. Now again guys, you do not have to do $3,000 every single month. We are making good money now, and therefore we are investing $3,000. You can start with 500, 100, 200, whatever that number is, but I'm just giving you the principles that we should invest in, the principles that I invest in. And then if I talk about the platform, I use Wealthsimple Trade. You can use any platform that that you like, but I use Wealthsimple Trade because of 3 main reasons. Number one is it's backed by Power Corporation of Canada. It's a $65 billion listed company. Now, even if Power Corporation of Canada or Wealthsimple Trade was to go down, my money is actually protected through CIPF, and that's very important in Canada. All major banks and all major companies, investment companies, are actually protected by that. And it covers up to $1 million of liability. If the company is to go down and I had $1 million in Wealthsimple, I'll get the money back. And the other thing that I like about Wealthsimple is that my bank credentials and my login credentials are actually saved on the phone and not on the app, or not. Wealthsimple doesn't have that information. It's just with me on my phone. And the fourth one, and that's true for almost every other app that we can use to invest, is it is low fee. It's at least lower fee than what the bank charges. Now, you don't have to use Wealthsimple Trade. I use it because I've been doing that for the last 2.5 years. I trust the company because of all the reasons that I mentioned here. And if you want to use Wealthsimple Trade, my referral link is in the description below. I'll make a small amount of money if you use that, but you'll not lose anything. In fact, you'll get $10 to get you started with Wealthsimple. And finally, it's time for Wealthsimple tutorial on how to use Wealthsimple. However, I will not be doing that, and I'll just be leaving a link in the description. Now guys, the reason why I'm not doing an end-to-end tutorial on how to use Wealthsimple is because I actually want you to do some research and some digging around it. It's not very hard to find these tutorials. There are so many people who have made them on YouTube. You just need to type. Even Wealthsimple has made their own tutorials. It's a very simple thing to do. You just need to get started. Just download the app, use the link in the description. Do YouTube, do Google. There's a lot of information on how to do it. And to be honest, it's not very difficult to do. And if you're not able to do that, then it's very difficult to actually invest and very difficult to research. So this is a way of just me telling you that I'm not going to spoon feed the tutorial to you. You just need to figure it out yourself. And to be honest, I'm not the smartest person. If I can figure it out, you can too. In the end, I'll just say that stock market can be made very complicated, but we need to keep it very simple. And through this video, my only intention was to tell all the beginners out there, or even if you have been investing for a while, you do not have to break a sweat. It's very easy to make 7 to 10% return, and you actually don't have to do a lot in order to achieve that. I hope you like this video. Do share this video with friends and family who wants to invest and who want to know how to invest and who want to understand and are overwhelmed by all the information that is there in the stock market. Just tell them that it's not that difficult. मिलते हैं अगली वीडियो में, तब तक के लिए बाय बाय।